Good afternoon, everyone. Happy Wednesday to you from Gibraltar. Hope you're all okay. Nice to see you all here. What are we going to do today, guys? Well, what we're going to do today is we're going to be following on from our initial price action, 5-point filter price action strategy. And we're going to be moving on to an intermediate, more advanced strategy, guys. So how many of you guys attended the last session? Because if you didn't, it's okay. I'm going to recap what the strategy is and what it entails. And we're going to have a little look maybe at an example as we go through it. Okay, well, it's not a problem, Ray. The video is available for viewing, as I say, in the place where you registered here and also in the archives. But don't worry too much, guys. What I'll do is I'll put an onus on showing you the price action strategy initially, and then I'll take you through the sort of intermediate one. So as we begin, guys, basically the basic strategy and how I like to trade when I am obviously in front of my screens is to use price action combined with a bit of oscillator action and volume. Volume is the key component, guys, for the basic strategy. And just to recap what the basic strategy is, it's very, very simple. Okay, it's a mechanical strategy with a discretionary bias. So what that means is there are certain rules that we have to follow, okay, in order to execute a trade, and certain criteria that has to be met. But at the same time, there is an allowance for discretion, because in my experience, from one of my prior sessions I've done with you guys, I find that discretionary trading is the difference between a good trader and a great trader. Being able to just define whether, you get a trade signal and whether or not maybe the fundamental tells you to not trade it, or being able to see that there's something else in the market that tells you shouldn't really be looking to put that trade on. That, for me, enables profitability to be a lot better in traders. How many of you guys are mechanical? Are you all just purely mechanical traders, or do you employ a little bit of discretion into things? Hi, FX Boyke, nice to see you. I know you attended the last session, so we're just going to recap on the basic strategy. How many of you guys are mechanical and discretionary traders? Just give me an M or give me a D if you're a mechanical or discretionary. Okay, so you don't really use any discretion. Okay, that's fine. See that Ray says no discretion. No, says he doesn't know. Well, that's okay. You'll know there's a few simple rules to see if you're discretionary. If you make allowances for trades, you have fixed criteria, but you don't necessarily always follow stringent money management. So, for example, you'll trade less on weaker signals and categorize trades, and also, maybe use a bit of discretion around news events. They're general things that make you a discretionary trader. They're sort of choices that you make. Mechanical traders will follow every single signal that they get, and mechanical traders have an advantage in the sense they don't have psychology so much to affect them, whereas discretionary traders have a bit of a disadvantage because they're not bound by market movements and by signals that they get. So this strategy here is mechanical with the discretionary bias. Okay, and the basic premise of the basic strategy was that we use 5 filters. Okay, very, very simple filters, guys. We use RSI. Okay, we use support and resistance graded. Now, very, very simple to grade support and resistance. We'll have another look at this in a second. And basically, we're looking for a price action reversal pattern. It is a contrarian strategy, and it can be used on any time frame, bar the 1 minute. Really, I find that 1 minute's very, very white noisy, and I prefer to use sort of the 30-minute myself. And the basic strategy literally employs just very, very simple 5 filters to help us with our money management. So if we have a look at what those filters are, the basic strategy that we're going to be building on today uses price action, as I say. So we use sort of candlestick analysis, very, very simple. Okay, you'll notice that it's in red because it is very, very important. Okay, it's one of the key composites of this strategy. And what we're looking for we're looking for things like tweezer tops, tweezer bottoms, bearish engulfing patterns. Can anyone think of any other double, single, treble candlestick patterns that we might potentially use for this part of price action? Anything at all? What about you, Ray? Yeah, doji, absolutely doji, which indicates a decision. Bearish and bullish engulfing, absolutely, Dwayne. You're absolutely spot on, guys, with that. Absolutely spot on there, guys. Hanging man, another good one. And so, hammer, very, very simple patterns. But you can even use things like head and shoulders and double tops, triple tops, and things like Elliott wave and so on. But we'll talk about that when I do another follow-up, which is the advanced pattern. Evening star, Jimmy, absolutely great, guys. You all know your price action sort of reversal patterns. Okay, so they're very, very important. The other thing is volume. Volume is absolutely crucial, guys, because volume basically will tell you whether a reversal is actually a reversal. Okay, there's no point us having an evening star, a shooting star, or a pin bar, as Rahul so rightly puts it, or a hanging man, or a doji, if the volume is not there. If you have low volume, generally that indicates that the market is, very weakly reversed. So let's say that we were to go to a chart now, and I'll just move away from an example that I've already punked on the chart, and we had to get a doji here. There you are. We've got some dollar Swiss, very, very strong up move. Okay, if the volume on that reversal pattern is very, very low, that indicates to us that there's potentially not indecision in the market. What that indicates to us is that potentially, it's a very, very weak move. Just like when you see a breakout, guys. How many of you guys trade breakouts? With Forex, you have to use a little bit of discretion there as well. I say this every time, I've done lots and lots of testing. Now, I use a DMA system, thing called Trading Technologies, which gives you actual market depth for trading a lot of products. But when it comes to Forex, obviously, there's lots of different liquidity providers. So generally, what I like to look at is I generally look at a couple of different brokers who use different liquidity pools. And you can use this volume is generally representative of the market overall. Okay, generally, you will see the volume across all brokers, fairly similar. If volume is higher, it's higher. Okay, and you'll be able to tell if the volume is higher because you'll be able to tell things like, the reversal candlesticks combined, as I say, with, whether or not we have a strong move or a strong reversal. So in Forex, it is slightly more difficult, but you can use a lot of the broker volume that you get on MetaTrader. But again, always use it with a little bit of caution. If you're watching the market as well, guys, you can see that price action. You can see that the market is to and fro. So you can use it, guys. I've done about 2 years of testing to see how good the volume is with regard to my own strategies. And because I've been working on some EAs and some algorithms, and it's absolutely fine in my experience. But again, you guys, you should test that out yourselves and see for yourself what's going on. So the basic strategy, as I say, volume is a key component there, but it's not just volume, okay, guys? It's also, support and resistance. Now, I generally grade support and resistance levels, okay? And the price action strategy and the intermediate strategy we're going to be talking about grades them as well. Very, very important to remember that, because when it comes to trading on just sort of an intraday time frame, which is generally what I do, I like to still have my daily levels. I still like to have my intermediate levels, and occasionally I would like to use my 5-minute levels, my what I call short-term levels. Generally use them as profit targets. So what you're looking for are the red levels, always the big daily levels. The purple levels are generally your intermediate, so your hour, half-hour levels, and your green levels are sort of your 15-minute, maybe 5-minute level. And generally, I don't usually trade around green levels using this strategy, but I do use the green levels as a profit target, because they are sort of weak areas of support and resistance. You can generally get a bounce off them, and so you can use them for potential profit targets, just like using pivot points and other indicators. As well as that, we do use RSI, guys. You'll see that's in orange because it's sort of the second tier of importance. And what I like to use with the RSI, 2 types. In a market that's clearly in a strong trend like we see here, we use something called the average ceiling and the average floor. And the average ceiling in any oscillator that you use, I'm going to use RSI to show you guys because it's very, very simple. The average ceiling is just generally the average of the last month's worth of candles at the very minimum. I like to use as many as I can. So in this example, we date all the way back to July of last year, nearly a year's worth. And what you do is you look for the average ceiling. So whenever a market is trending, we're looking for around the average ceiling. But whenever the market is in a range, we can use the 70 or we can use the 30 level. So if we look at an example on the chart here, we can see sort of scrolling back, you can see that the RSI generally very rarely seems to break in this dollar Swiss. That sort of 19, 18 level. And again, a little bit of discretion is required. Generally, we get a bounce off that level, okay, because we are going to be using the RSI for twofold. We're going to also be using divergence, and we can see actually we've got a little bit of divergence forming. Now, price looks like it's going to move higher. Not quite moved higher yet, but the RSI has failed to put a higher high, and that tells us potentially the price is going to consolidate or it's going to reverse around this resistance level. So they are the filters that I use, guys, with the basic strategy, and it's very, very simple. Okay, when it comes to using this strategy, we move into a market, and I have prepared an example actually from from sort of today. We have New Zealand dollar. In fact, we don't have New Zealand dollar. We have Aussie dollar that's forming. Okay, you can see that basically we have a nice support level on the chart here. Okay, and what you see is we get a very big shooting star. Now, using the basic system, it's very simple. We're looking for trading to take place around our purple or our red levels. Okay, the first signal is that we actually test this level. Okay, and remember, it can be a zone, it doesn't have to be a level, and we can see this cable that actually got a little bit of a support zone. If you go back and have a little look, guys, from last week, you'll see that actually this is a very, very, very good sort of support area on the chart that was a resistance. And again, look, it goes all the way back to sort of this area here. Okay, so we're looking for that level to get tested. Okay, that's filter one. And if it doesn't get tested, you know, we basically don't look for a trade. Now, with the basic strategy that we've been through before, we then look for a price action reversal to take place. Now, you'll see I'm using the 30-minute chart, but again, you can use other charts. So you can see in this example, we have got a what, guys? What reversal pattern is this? Off our support level when we're clearly in a range. What have we got here? What sort of candlestick pattern, guys? Hanging man. Well, it's a hammer, but yeah, hanging man's at the top generally, but a hammer pattern, absolutely spot on, Dwayne. Same thing, except one's at the top, one's at the bottom. Okay, and so we get the reversal pattern. And again, it can be tweezers, it can be bottom tops, engulfing patterns, even head and shoulders, things like this. Okay, and that's the second filter. As long as we have one of those, we then look to volume. Now, the rule of the basic price action strategy that we're going to be building on today is that volume should be immediately above the prior two candles. And we can see with this example, with this nice hammer that we have, we can see the volume absolutely massive. Okay, highest volume of the day by far. And that tells us basically that the buyers have come in around this level and pushed us higher. That tells us there's some initiative or responsive buying in the market to reverse this range that we're in. And so that's our third filter. Okay, the very important filter is volume. The fourth filter that we use with the basic strategy is the RSI. And what we're looking for is when a market is ranging, we're looking for it to have tested the 30 level for a long bounce, like we can see here. And the fifth filter that we use is we're looking for divergence in the market. So we're looking for the market to make a new low, which it does there. And we're looking for either long-term or short-term divergence, which we can clearly see here. Now, if all five filters align, that gives us the optimal trade setup. Generally, we'll look to enter into a position where we look to pop on a long trade on the open of the next candle. Okay, and I'll mark that in blue for us. Our stop loss is very, very simple. It goes below either the support and resistance level, or it goes a discretionary amount. Generally, guys, things like average true range for your stop loss, you know, one average true range can be used, but I'll just plonk it onto the chart for now, so we've got the stop loss in place. Okay, and this is actually from last week. You can look at this one yourselves. And then you will determine your money management. Now, with the basic price action filter, guys, and again, I do say you should endeavor to watch the video so you can work out how we do money management. It is a bit discretionary, but generally, guys, as long as you have two of the big filters, so as long as you have two or three of the things here that are in red or orange, you can look to trade. One crucial component is the support and resistance level. Another crucial component is the volume. Without these two, you know, generally I'm not looking to trade, but also the price action, very important. So generally these three here, you know, enables me to probably trade anything up to about 1% maybe at a maximum. Okay, and again, this is all in the other video. The RSI adds another sort of 0.2 to 0.5%, again, using a bit of discretion. And then to trade that maximum 2%, there also has to be divergence in the market. So as I say, this is in the other video, guys. And it's very, very simple. You're basically looking for price to reverse. You're obviously using prior levels, maybe as your support and resistance levels as your profit target. So we can see that what I have a green level. Okay, it's not really an intermediate level, guys. We've got a lot of congestion around there. So I have that as a short-term level. So, you know, I use the green levels, use purple and red levels. Again, we have another green level around this area. And I'll probably use those as my profit targets, guys. And as we can see, price basically begins to break higher. We touch our profit target there. And as we continue to move, okay, you can see we begin to form a little bit of a range before, obviously, as we already know, breaking down. Okay, so that's the general premise of the basic system. So any questions so far, guys? And again, if you haven't watched, I do endeavour that you would endeavor that you try and watch the video if possible, okay, from the prior session. How much ATR do I use? Well, with my ATR, guys, you will see that I use a 20 ATR. The reason I use a 20 ATR is because there are 20 trading days in a month. I like to always look at things from the monthly perspective, and it's a nice round number as well, always good to use. And generally, you know, I'm looking at sort of 1 times the average true range of a particular period. So, for example, we can see that the average true range comes down here, it moves higher. So it's quite volatile. So you're looking for sort of the midpoint, guys, of the average range, something around here. So it's around sort of 7-8 pips. And that's generally what you can use for, you know, determining your stop loss. You can always pop it just below the low by 1 times the average true range. Generally 1 times the average true range for the stop loss. Would I have taken this trade? That's a very, very good question. I actually did take the trade. This is a counter trade system. It can be used for continuation, but we're focusing on the counter trend. The reason is I find this works very, very well in markets that have been within sort of a lower volatility and ranging for a while. We can quite clearly see that this Aussie dollar, you know, it's been ranging in a big range from 94 to sort of 93.25, but it's in a range nonetheless, guys. You can see quite clearly that we are in the range here with our support and resistance level. There's not a big long-term trend, you know. And so for me, that is a level that I would take. And again, I judge each trade by its merits. I will try and find the, maybe the panelists can link at the end of the session, but it should be in the news where you can sign up to this webinar, guys. So anyway, we're going to crack on. What I'm going to do is I'm going to link you to the webinar. There you go, guys. It's in the box for you now. That's where you can watch the first webinar. We're going to move on now, guys, and we're going to have a little look at some actual examples that we can, you know, develop on. So the basic strategy is there, guys, and very, very simple strategy. Very, very simple, but very, very effective. So moving on. Okay. When it comes to developing a strategy, this strategy can be used for sort of trying to optimize entries. One of the problems I found with using this strategy is, and this is a very, very good example here. Okay, so I'm just going to delete these lines and make it a little bit clearer for us. Okay, very, very good example is this strategy, guys. We get a shooting star and our support level is around about this area on the chart here, guys. Again, we've scrolled back already. We can see it's around this level. Okay, what do you think is the issue, though, of entering into a trade at this point here, at this 93.39? If our support level is all the way sort of, our support zone is this yellow area here. What could be the issue with that, guys? Any ideas? You know, would you be happy to enter into a trade on a bounce, on something that's bounced sort of 15 pips from the support or resistance level? Yeah, absolutely, Ray. We have big stops. The other issue is it's something called value trading. Okay, it's all very well and good trying to get a reversal of a level. Okay, but if you move too far away from the level, we can see we're about 15 pips away from the start of the zone. Okay, that's not actually the whole zone. That's the start of the zone. Remember, guys, when we scrolled back, we had a look. Okay, the average true range at this point is only 9 pips. So we're actually 1.6, 1.7 times further away from, you know, we're a whole candle and a half away from that support or resistance level. So one of the issues you've got is that stop loss will be larger, but also you're trying to enter into a trade that is basically, for all intents and purposes, back in this range. You know, the range itself is about 80 pips. If you're entering into a trade 15 pips away, you're entering into a trade around sort of 15, 20% within that range, a retracement through that range. And what that means is, you know, yeah, there's a risk to your profit ratio. Absolutely, Brennan. And I'm all about big value trades. That's why I like to trade news. That's why I like to trade with optimal setups. So one of the things you can do with this particular strategy is just use multiple time frame analysis. How many of you guys have ever used multiple time frame analysis before? Have any of you? Okay, Ray Frith, maybe you can just explain to the other users what it is for us. See you typing around. Afex Boyke has, Jonathan has. Okay, cool. So basically, multiple time frame analysis, for those who might not be familiar with it, is the use of more than one time frame. You basically take a longer time frame okay, to determine maybe a level that you'd like to trade or a direction of a market. You then move to a shorter time frame, something like the 5 minute from the 30 minute. And the idea of the 5 minute or the shorter time frame, guys, is that you're looking to optimize your entry and your money management. And the idea is basically that hopefully, in this example, we've got a hammer pattern. Now we're trying to preempt to bounce off this level, this really, really good level that we've got. It should actually be marked up as a purple because purple is intermediate to me, okay? And this big sort of support zone. We're trying to preempt to move off that level. But quite a lot of the time, guys, when we actually get down to a level, rather than having to wait for that half an hour candle to fill, what you can do is you can just scooch down to a shorter time frame, okay, and look to see if you get a reversal pattern form around the level, because what that means is you could potentially enter a good sort of 15 pips lower, which would give you a better value. And it helps because what you can always do is you can look to, minimize your risk reward. You can always, as I say, have more volume on, or what you can do is say to yourself, right, so once this hammer forms on the 30 minute, like it does, my stop loss is going to be 20 pips away. So I'll work out the volume that I should be trading with 20 pip stop loss. But you can actually, maybe reduce the risk a little bit by risking just 1% and having the same sort of outcome, the same sort of volume on. So very, very important. So using different timeframes to use a level is important. As you are so nicely FX Boyki, there you go. So when we look at multiple time frame analysis, generally there is a little bit of a rule. Okay, I like to use a 30-minute and 5-minute. I like to use a 1 hour and a minimum of 15-minute, a 4 hour and 1 hour or 30-minute, and a daily and a 4 hour or a daily and an hour. Now, does anyone see a pattern with that, guys? Anyone see a pattern with that multiple and time frame analysis that we appear to be using? Because the pattern, I'll give you a couple of seconds to think about it, maybe type if you are, and answer it. Okay, now the difference, or the similarities rather, you'll see, is that there's at least 4 periods between them. So if we look at 5-minute and the 30-minute, okay, there's at least 6 5s make 30, 6 periods between. Within 1 hour and the 15-minute, 4 periods, 4 hour and 1 hour, daily and 4 hour again. You've got 6 and you've got 4. And the reason is, guys, that if you were to use, say, a 30-minute and a 15-minute, the candles, and let's just plonk onto the chart again, the candles are very, very similar. Okay, let's say that we were to use a 1 hour and a 30-minute. You don't really get to grips with the inside out sort of underneath the bonnet look of the market. They're very, very similar. Whereas a 1 hour or a 30-minute and a 5-minute can obviously give you a much sort of more broken down look at the market. It's actually, we've got a nice head and shoulders there, guys, forming on the dollar Swiss. So generally, guys, there needs to be a 4-period thing between your multiple time frame analysis that you use. Now, the idea with this strategy is we're trying to preempt a move. So what we're going to do is we're going to look at that Aussie example because, again, it's a very, very good example, a trade that I actually took, and so I know it's a good example. So we come to the market here, guys. We see that we have a nice support level, don't we, on the chart? Okay, so we're thinking to ourselves, right, it's looking like potentially we're going to hit oversold. It's looking like, we could eventually trade this sort of lower the range, the support area. And so, let's see if we can get a trade on. And what you would do is very simply, you would, when you get to within a certain period of the level, and generally, again, I use a 1 average true range whenever the price gets within sort of 1 average true range. So we know this is about 9 pips at this point, sort of to around this level here, this sort of 93.35 level. You flip to a shorter time frame. Okay, so we flip to the 5-minute chart. Okay, and what we're going to do is we're going to look to try and preempt a possible reversal using the same sort of filters that we use with the basic strategy. So we can see we come to market at this point, okay? We get within 1 average true range of the level. Now, what we're looking for is we're looking for this price to get traded, okay? And we're looking to try and preempt the move. So if we pop back to the slideshow and move on, okay? So we move up on the 5-minute here to the high, you can see to our purple level, and we're looking for a rejection to occur. So popping back to the chart, we pop back again, we move along, and we get pretty much a little bit of a rejection off that level. Now, it's not the best shooting star, and again, this is why I like to use discretion, guys, because a hammer, a knife hammer would be something like that with a bigger tail, a nice, long tail. This is a good example of a shooting star, but obviously it's in the middle of a range, so it's no good. So you're looking for a bounce. Okay, you say to yourself, right, I'm trying to preempt. ATF of the higher time frame before you move on to the 5-minute chart. Yeah, absolutely. We're going to talk about that in a second, Rafe. Do you mean like 4 hour and hourly? Generally, I mark the levels up and then I will keep an eye on them, but generally, I don't like to look at too many time frames because you'll distort your view. Each time frame can tell you a different story potentially. So I usually stick within the 2 with this particular strategy. And as I say, FX Boyke, I use the ATR of the higher time frame before moving to the 5-minute or the lower time frame. So guys, we come to the chart, we can see clearly we have a bounce. I think to myself, well, it's not the best hammer that we've got, but we have bounced off a good level. We are ranging. So let's have a little look at our 5 filters again. So again, you use the 5 filters on this time frame, and the idea is we're just trying to preempt that 30-minute rejection. So we have a little look at, have we touched the support or resistance level? Yes. Tick. Have we touched, a good amount of volume in this candle? What do you reckon, guys? Do you think that's decent volume based on the perception that we have here? It can be too noisy, which is why you can use the hour and 4 hour and lots of different time frames. I'm just using this because this is an example that I use quite a lot. I trade 5-minute and 30-minute quite a lot. Okay, so I think the volume is quite good. I agree with you, Ray. I agree with you, Jonathan. I think, we're not as high as this volume here, but, there's a little bit of a rejection creeping in. So very, very good volume, much higher than our prior candles. And again, a little bit of discretion. Just have a little look over and see how that volume is, much better than the early afternoon. So I then say to myself, right, has the RSI breached 30? First of all, I look to see what our market conditions are. We're clearly ranging, guys, on the higher time frame. So I say to myself, right, am I happy that this is overbought considerably, bearing in mind that our average floor on a trending market is around sort of that 18, 19 area. Just pop it up there for argument's sake. So I say to myself, are you happy, guys, that that's looking oversold? Potentially we could have a little bit of a bounce. I would definitely say yes, Dwayne. Yes, Jonathan as well. So I agree. So I've got another couple of filters. Now I ask myself, okay, has price diverged? Let's have a little look at the RSI. Have we diverged? Well, not really, but there's a 2.4 point divergence. So there's a little bit of divergence. So, okay, the 5 filters, not only are we going to try and use them on the 30-minute chart, but we've already looked at the 5-minute chart. We've scaled down, and now we're looking to use those to potentially preempt this move and improve our value. So we ask ourselves, is the RSI acceptable? Is the RSI diverged? Is price indicating a reversal? Has the level actually traded? Very important that the level or very, very close area to that level trades. If yes, then using the 5-minute or the lower time frame rather, not just the 5-minute, I will generally, and this is just me again, guys, maybe you can tweak the strategy. I will generally enter a maximum of 50% of the trade volume that I would risk trying to preempt this 30-minute move that we're waiting for, okay? Because again, the 30-minute move is the primary indicator that we might have a longer-term reversal. We're looking for the longer-term reversal, okay? The shorter time frame has a lot more noise on it, as you so rightly pointed out, guys. So I like to make sure that I risk less. So generally, I will risk anywhere between 25% of sort of the total risk of my account that I'm going to put on this trade on the 5-minute time frame. So it would be if I'm risking 2% on the account based on sort of what I'm comfortable trading, my general money management parameters, and how strong this signal is, guys. I will say to myself, right, I've got sort of 4 or 5 of the filters there. They're not great. A couple of the filters are maybe a little bit weak. So I'm not going to risk, 2% because the chances are we're not going to get a optimal setup on the 30-minute. So I'd say to myself, I'm going to risk maybe 0.25% of my trade. We could wait for the next candle. Again, absolutely great, Ray. The good thing about trading is everyone is sort of a different trader. I'm very, very aggressive. I don't make any, excuse for it. I'm a very aggressive trader. It works well for me. So, for me, if you get a good confirming pattern, so say we were to get a very, very good confirming hammer pattern here, let's pretend this was the level, would you wait for this candle to move higher? Potentially you could. And, that's something, guys, I'm just giving you the basic framework of a strategy. You guys go away and play with it. Maybe there's one thing you like about it. Maybe there's nothing you like about it. Maybe you like the strategy and you're going to try it on a demo account and just see how it goes. The whole point is, guys, go away, work on it and see how it goes. So, what we would do here is probably risk very, very little, okay, on this trade because we haven't got the optimal settings, okay? So we're preempting, as I've said, the move. Okay, so what we do then is we just very simply stay on the 30-minute, 5-minute chart until the 30-minute candle confirms. So we know that there are 6 30-minute candles to a 6 5-minute candles, sorry, to a 30-minute chart. So first candle here, 2, 3, 4, 5, 6. We get a bit of a bounce. Okay, so at this point, what we do now is, and bear in mind that we have obviously entered at this level. Okay, put that in blue again, and we've got our stop loss below the low. We then move back to the 30-minute chart, and what we're looking for is we're looking for a confirmation that we have got the bounce that we're looking for. So I'll have to pop it onto this one because that's when the new candle forms on the 30 minutes. We plonk it onto the chart, and you can see quite clearly that have we got a reversal pattern formed here, guys, on the 30-minute? Absolutely, Jonathan. Just remind me at the end, I'll explain it. Have we got a rejection candle, guys? Yes, we have. Okay, we've got that rejection candle. Okay, so what we've done is we've managed to enter into half of our trade or up to half of our trade a lot earlier than we would ordinarily, a good 10 pips higher. Okay, so we have got 10 more pips to play with. We're actually in profit. So what the multiple time frame analysis will do is it will allow you to, hopefully optimize your entry. Okay. Now, once we have a look at the 30-minute chart, we need to put the rest of our trade on. So we look to have a little look. Has the rejection of the level occurred? We go through the 5 filters. Have the filters met the remainder of the criteria that we have? Well, let's have a little look. We've got a hammer pattern. Yes. Have we tested the level? Yes. Is the volume good? Volume is absolutely spectacular there, guys. Have we got a bit of divergence? We know already from earlier in the session, we had a tiniest bit. And have we touched the 30? Well, we've not quite touched the 30, which remember we're in a range. So we use the 30, not the 18 or the 15. Okay. So I say to myself, okay, I'm happy to put the rest of this trade on. If you're not happy to put the rest of the trade on, if a reversal doesn't look very good, if you haven't got the sort of 3 filter minimums that you need from the basic strategy, all you can do is just leave this little bit of the trade on. It's a free trade. Okay. If not, if you are happy, you can look to enter into the other half. And what that means is it means that we've now scaled in and we have optimized the basic strategy entry level. Okay. Basically, we are in at around 33, 34, as opposed to being in around 40. Okay. So again, guys, it helps to optimize the actual trade. Now, that's not just the whole strategy in its own. Okay. That's not just a strategy in its entirety, guys. There are other things that you can do to optimize your entry and to make sure that you don't end up in a negative trade. Okay, but it's very, very difficult at times to implement. So with this example, we can see our 30-minute has formed a nice tweezer top. We can see very clearly from that we've formed that there. Okay, on the 5-minute, we had obviously our nice bearish engulfing pattern and our doji. Okay, and so what happens then? Trade comes off and we get to have a nice optimized entry. Instead of selling it here, we've actually sold it pretty much on the high and, entered the rest of the trade. So we've got a very, very nice average. Now, as I've said, the distance from the level is crucial when entering on both time frames, guys. Okay. Value trading, guys. Okay. In this example, if you want to just trade the basic strategy and you don't like multiple time frame analysis, you can still introduce value trading into your entry level. And it's very, very simple. We enter into the market here, we should be with a basic strategy, shouldn't we? Okay, I'll stop this below the low. But as we've already said, we're 15 pips away from our ideal optimal entry. What risk reward ratio do I use? Generally, it's determined by support and resistance levels. So generally, I will always look for, a minimum of a 1.5 to 2 to 1. This strategy is actually about a 3 or 4 to 1 average based on me trading it over the past, however many years, quite a long time. So in this example, you can see, the risk 13 pips. So, the reward, I'm looking for probably a move. There you are, 23 pips is the first level. And one of the things I will often do is put an optimal profit target. So start with the optimal profit target. This is the optimal one, guys. But it's, unlikely we're going to get all the way there. So what we do is we look for an area on the chart we're going to monitor. And if we reject, we'll obviously look to get out some of the trade here or all of the trade. Again, scaling out, guys. I've done a session on Tradimo on scaling out. I'll happily take you through scaling out. And scaling in should you wish and there is a demand for it. But generally the risk reward ratio is determined by the entry point to an extent, but it's generally more determined by the the longer term time frame. So the higher time frame, remember we're preempting on the 5 minute, our risk reward ratio with this trade would be actually minimal. We wouldn't want to get out for 10 pips when we're looking to try and preempt that 30-minute move. That would have been a massive risk reward. If we say that we'd entered around here, which is about where we entered the 30, that would have been 8 pips to sort of 30 pips. So, a 5 to 1 ratio. Okay. So, again, have a play with it, but generally I use the higher time frame. Minimum of 1.5 to 2 to 1 is generally what I'll look for. But however, guys, I don't let the risk reward ratio at the time annoy me and focus on my trade. And the reason I don't do that, guys, is because over a series of trades, I know the risk reward ratio of this trading system is around 3 to 1. So if one trade, the risk reward slightly skewed, it doesn't really bother me because I know over an average, trading's about an average. So as I've said, guys, the distance from the level is crucial when entering. Okay, so when you look at the market, okay, and you look to enter, even if this is just on the 30-minute time frame, on the higher time frame, very, very simple, guys. Okay, what you're looking for is you're looking to make sure that we are within at least 1. And again, you could do it maybe half. So we've got about a 10. We're looking to see if we're within that sort of 1 ATR at maximum of the support level or the resistance level. In this case, you can see that we are 15 pips away from it. So we're 1.5 away. And if we're too far away from it, one of the things you can actually do, guys, is instead of just entering into the trade, because again, if you didn't want to trade with a multiple time frame analysis, you wouldn't be in at this level. But rather than enter here and risk, making yourself have a very bad risk reward ratio or a large stop loss, what you can actually do is 2 things. You can risk less on the trade if you are more than 1 ATR away from the support level, because the value is, guys, remember we're 15 or 20% back into this big range that we're in. And so, the value is we could easily just consolidate for ages like this, and that would be very, very bad. Okay, so you can risk less. Generally, I'll risk upwards up to 50% less, or more likely, what I actually do, guys, okay, is I look to scale in to the market. So what I will do is I will pop this on here, and I will stick a Fibonacci on the candlestick itself. Again, that Fibonacci is not drawn correctly, but let's just get it in black so we can see it. So I'll draw a Fibonacci, okay? And again, let's just delete that Fibonacci and draw it correctly now, shall we? So draw it onto the chart here. And again, it's going to be very hard for you guys to see this. And I will look to scale in around the fib level. So the 50%, the 61.8, maybe the 79% if you want to use that, guys. And the idea here is I'm looking to, again, optimize my entry, okay, on this reversal. So I look generally around the 50 and the 38.2%. Are you a bit impatient trading? I prefer the term aggressive. FX Boyke, not necessarily impatient. I'm very, very patient when it comes to waiting for levels to form, but I have been known to jump in at times, like all traders, pretty much. So one of the things you can do is you can very simply look to just scale in, guys. And again, optimizing the entry if you're more than one average true range. And again, test it. Maybe 2 average true range works for you. Maybe half an average true range works for you. Just trial it out, guys, on a demo account and have a play. You generally look to scale in, and in this example, if we just get rid of the Fibonacci now, because it's blocking things a little bit, we can see we move up straight away. Now, obviously, guys, there is a little bit of a risk that we're not going to get filled. Okay, so there is always that factor. But generally, it will ensure that, you know, you're not buying it or selling it miles away from the level. So again, let's have a little look. We get a bit of a tweezer topping cable. Okay, are we overbought? Massively overbought. You know, was volume good? Up. Yep, 2 candles, volume's good. You know, we could have sold it at 10 pips higher if there was a reversal signal. Now, there might not be a reversal signal on the chart, but if there is a reversal signal, we should give it every chance to, you know, show itself. And if we have a little look on the 5-minute, there you go, guys. We trade up to the level with 3 pips as opposed to 10 pips away. So again, you've got a 7 pip alternative entry level. Okay, good. How many pairs do I review for trades? Every pair, pretty much. I'll be honest with you, Danny. I don't limit myself to few trades. Euro, New Zealand dollars, not one I actually trade because liquidity, and that's pretty poor. Anyway, we'll have a little look at that at the end, maybe if we've got a couple of minutes. So basically, again, you can use this ATR method or Fibonacci method. You can use it on the single time frame, the higher time frame, or the lower time frame. Now, another thing to consider, guys, with the intermediate strategy is when you're using the lower time frame, okay, or even on the higher time frame, the rejection of the rejection is something that is very, very dangerous. Because this is a contrarian system, and it's something in the market that, you know, we're going against the trend in the market. A rejection of a rejection can often indicate that the market isn't actually going to go the way that we've said. And things that indicate a rejection of a rejection, let me find an example for you here. There's a little bit of an example here. Now, you'll have to use your imaginations a little bit. When I was showing you the cable. Okay, we get a bit of a shooting star. Is it around a resistance level? Well, it's not a great level, but I mean, it looks okay. It doesn't look too bad. Okay, we get a bit of a shooting star here. Now, let's pretend that it's at the very top. It's an amazing level. Okay, if the market generally has a rejection of a level like this one here, but then we're followed by another rejection afterwards, that indicates that potentially the market is going to continue potentially in the trend. So we get a tweezer top. There you go. This is a good example. Okay, then after that tweezer top forms around this resistance level that's now formed, okay, RSI volume both high. What happens is, okay, and again, this is something I look at on the lower time frame more than the higher time frame, guys, because again, we're trying to preempt that higher time frame, so we need to be careful. Okay, have a little look. We get sort of a rejection. Now, generally, the biggest rejections are things like a shooting star followed by a hammer immediately, or a hammer followed by a shooting star. Because what that can indicate one of two things. It indicates we're not going to reverse, okay, or it indicates that the market may be entering a period of consolidation, okay. And when you're on the shorter time frame, on the 5-minute, trying to preempt a reversal, you know, there's no guarantee that, you know, your 5-minute could just consolidate and the 30-minute may not form that reversal signal you want. So generally keep an eye on the 5-minute. If you get a rejection, okay, candle, similar like this tweezer top, and then you get another rejection after that, that sort of neutralizes this rejection. You've got to use a little bit of discretion and be very, very careful with the trade potentially. I've scalped a little bit. How many trades a week do you find on an average week? I've had most trades in a day I've ever had, and don't judge me, was 120 something in a day. That was during the financial crisis. Am I a scalper? I'm a culmination of lots and lots of things, FX Boyke. I'm predominantly intraday and a little bit of a swing trader. I've got some long-term investment stuff, short gold, etc., at the moment, from sort of April of last year. I don't really like to scalp on a retail platform. You know, scalping is really for people who have very, very low spreads or pay a very small commission. You know, guys who are trading technology, TT, for example, That's the best scalping platform. You can jump in and out. So I'm more of an intraday trader now. What hours? Well, generally the hours will be from around 10 o'clock, 9 o'clock. Trying to work out Eastern time. If we go with just London time, when I was trading in City of London, I was in the office for 6:30 in the morning for the open at 7. When I trade in Gibraltar, generally the market's open at 8. Generally, I don't trade the first hour. Generally, from around 9 o'clock onwards, I look at my charts, have a little break over lunch, and then carry on throughout the course of the afternoon. So, lots and lots of pretty much I'm one of these that I have to be in it to win it kind of thing. I like to look at the markets. I know guys who trade for 2 hours. They're very, very successful in the morning, but generally I like to trade a little bit more. So guys, as I said, the rejection of a rejection, and here's a good example here. We move down, we get a tweeze at bottom, but very, very quickly we get another rejection. Can you see that? And what that does, even on the longer time frame, but generally I use this on the shorter time frame, you'll see that the market can either consolidate or obviously it could begin to move lower. So that's a reason to maybe exit the trade. Another thing is on the shorter time frame, if you move on side by an average true range or 2 average true range on the lower time frame, I will generally put my trade in for a break even until that 30-minute chart develops. If that 30-minute chart develops into the pattern I'm looking for, then I will keep the stop loss below. But generally, a break even, it doesn't do you any harm, to have a free trade. If the higher time frame does not confirm, I will generally put it in for a break even or exit the trade afterwards. And again, remember, volume is crucial. How did we come to name Trademo? I have absolutely no idea about that, FX Boyke. I have no idea. That is a very, very good question. I'll find out for you. So 9 a.m. London time, or 9 a.m. Gibraltar time, between 9 and 10, and then I'll usually stop trading. If there's FOMC, for example, we've got FOMC minutes tonight, I'll probably be hanging around till that's 8 o'clock our time. Probably hang around till about 8:30, 9 to trade it. So let's have a little look. Again, discretion, very, very important, guys, when it comes to trading using this intermediate system. Okay, there are a few tips that we can use. And again, very, very important that we use discretion. So I can see that Jonathan says he needs more. He only trades once or twice. Well, maybe look at the, excuse me, shorter time frame. But again, remember, it's entirely up to you guys. You shouldn't feel obliged to have to trade, excuse me. Some people are better swing traders or investors. So, there's no pressure on people to be trading. Just because there are opportunities doesn't mean you're going to make money in those opportunities. So bear that in mind, guys. So trading momentum, I don't think so, FX Boyke. I don't think that was the name of it. I'll have to try and find out what the logic was around that for you. Right, guys, so we are pretty much at the end of the session. We do have a couple of minutes left for any questions that you have. Does anyone have any questions? Speaking of Trademo, guys, whilst I'm waiting for your questions about ATR, that's Trademo there. I will find out what they're named. In terms of the ATR, the average true range is very, very simple. Okay, period is set like any other oscillator or any other indicator you might use. So basically, the excuse me, guys. Excuse me. So the average true range will take the average candlestick price over the last period. So in this case, the last 20 candles. Again, it will tell you what the average candle size is. So the average candle size is 0.0003. So it's 3 pips. So if we look over the last 20 candles, we can see we have a 2 pip candle there. We can see that we have a 3 pip candle there. So if we were to add up the last 20 candles at this point, here, and the number of pips each candle was worth, divided by 20, that would come up with our figure. And that's how we use ATR, Jonathan. Very, very simple and effective tool. Pairs I'm most active on, obviously euro dollar, although that's been very, very mean the last couple of days. However, very, very good one. ECB potentially coming up, cutting rates, very, very big opportunity. Free money, actually, a couple of weeks ago, guys. I'm very, very active in some of the Asian crosses. So like to trade Aussie dollar, like to trade Kiwi, especially with, again, the fundamental shifts that we've seen recently there. A bit of dollar CAD. I like to trade a bit of oil. I like to trade oil inventories. I actually learned to trade with Bund, Bobble and Schatz, guys, German government debt. So I do trade a little bit of bonds every so often, but I've stopped really trading those now. I focus more on stock indices, as I say, currency. I also like, I don't mind trading a bit of the Euro CAD, and I'm keeping a firm eye on Euro Swiss, guys. It is hard to make money on trading. It's just like everything else. To become a professional footballer, it's very, very hard. But, as long as you have a trading edge and you have the right support and, the right system in place and you implement the right money management, people do make money. I know at least 300 professional traders in the city of London. I used to sit in an office with them. If they couldn't make money, if it was that hard, some of these guys were not rocket scientists. Fundamentally and technically, recently I've been probably about 70% fundamental to 30% technical. But over the course of my career, probably around 30% fundamental, 70% technical. Purely on the basis that technicals are your bread and butter, fundamentals are your big swing days where you're going to make, sort of your year returns or something, month, 2 month returns, potentially depending on your money management. Right, guys, we're nearly at the end of the session. So before we go, as always, I'd like to thank FX Street and obviously Trademo for pushing me into this coaching session. This is the website here, guys. If you are interested in finding out more about what I do and Trademo itself, good learning education. We've got sort of free money, lots of promotions and offers, discounts, and actual free money without actually needing to do very much. Daily live online classes in our trading room, guys. This is the site, a nice community. More importantly, we are a community. So you'll always see us active in there, talking to each other, people like Hindsight, Tim, lots of other traders. And we do have a live trading classroom, guys, about sort of 25 hours to 30 hours of sessions a week, always adding new guys to that session, to it. And the good thing about it is your broker will pay for you to trade as long as you register with, one of our partner brokers. You actually earn things called Trademo points, guys. And those Trademo points entitle you to things like courses. We have lots of video courses. We have access to live classes, within the trading room where you see live trading, lots and lots of other things. And, you can actually just earn that through trading. But again, those who don't want to necessarily trade track can obviously just purchase their status system. Very, very important, guys. Even if you don't, start trading for us, the community, we have good few articles. Very, very important that you discuss your trading. That's how we develop as traders. We have a very friendly and helpful community. That is our mantra. So, guys, right, that's about it. I am going to love you and leave you, as they say. For those of you who are interested, I have popped my email if you'd like to chat with me about anything. If you would like the slide deck, okay, the PowerPoint presentation, again, just please just send me a message, and I will send it across to you. And, if you want to ask any questions, please do. And as well as this, guys, I'll give you my email that I'm on. I'll give you my Skype. So again, if you'd like to have a chat about anything at all, just give me a message. Chat Leslie Inman is the Skype. So, guys, I'd like to thank you all for attending. I think we're going to wrap it there, and I hope that you all have a lovely, lovely day. And again, I'm there to help you guys. So just, send us a message at any point if you've got any questions on this presentation or anything at all. Right, guys, I'd like to thank you and say goodbye. So see you later.